Hello and welcome back to the show. So I am super excited today to be sitting down here with my guest, TJ. TJ is a real estate investor since 2006, and he has been a part of multiple deals across Texas, California, and Tennessee. So investor in multiple states as well. And we're going to be talking a lot about some of the fundamentals of real estate investing and also how a real estate agent can make the transition of being an agent to looking at real estate from an investor's perspective as well. So it's going to be a lot of fun. And TJ, welcome to the show, man. Excited to have you here.
Hey, Kobe, thanks so much for having me. I appreciate being on.
Yeah, absolutely. So before we get started into anything, would you mind just kind of sharing your background or your story a little bit? How did you get into real estate and what was it that kind of got you to this point of being an investor in multiple states?
Yeah, absolutely. So it's kind of a meandering story, so we'll try to make it pretty brief. I started in 2006. I was doing loans in California way back in the day, so I saw some of the weird stuff that was in the pipeline. Thought that maybe didn't really want to be in the lending industry. I didn't like just being a loan officer. Thought it was kind of boring. So I found my first investment deal off of Craigslist of all places. Looked at a bunch of other things after that, but still decided that was the best one. The first deal was actually 112 units, apartment units in Memphis, Tennessee in 2006. We bought that thing in June of '06, so that was fun. It was a big rehab project. It was about 10% occupied when we got it. We got it up to about 90% of economic occupancy of available units before the whole like crash hit. So that was exciting. My second deal, not to be outdone, was actually, I guess the first deal probably did not do the second deal. It was only 98 units, so that was a step down. And it was more stabilized. So we acquired that one, like kind of restructured the management, fixed some of the bad tenant issues, and then refinanced it. My third deal was a house. So I bought a house that got burned off, and we did like 100K rehab on that one. So it wasn't until deal three that I got into the like residential business. Um, the problem with buying commercial, I guess in 2006, you could say, is 2008 was like kind of right around the corner, and we didn't really know quite so how bad it was going to be at the time. So that was exciting. 2000, it didn't really hit our field that badly until like I would say midway through 2009. So we exited both properties in I think end of 10, maybe beginning of 11, somewhere in there. So that was not fun. Back to California, I bought a bunch of stuff when it was on sale. So California, when something like 2008 happens, everything in California was like 40% off. And then the stuff that we were buying was actually we were buying short sales like 60 to 75% below what the loan principal balance was in like Inland Empire kind of towns and like Southern California, but off the coast. So we bought a bunch of those. Actually kind of cool. 1031, the last one of those into a Texas rental property out here. The cost basis was like 10 grand. We sold it for like 130 a couple of years ago and then dumped it into cash in a house out here. So that was kind of cool. Um, when did we move to Texas? 10 years ago, moved to Dallas because I guess 10 years ago, I didn't really understand the volume residential game. We thought San Diego stuff was getting too expensive, and I just didn't like it was difficult to do like a volume based business in San Diego. We didn't really know it. I know there's guys out there doing it now. I didn't know anyone at the time that did it. But we knew that game kind of existed in Texas. We knew stuff was more affordable and easier to kind of build a team and do stuff. And plus, just the geographic area of DFW being at the time, what, 6.5 million, and it's probably, I don't even know, bigger than that now. We thought, you know what, it'll be kind of fun. It'll be a fun change. So about 6 months after I got married, moved out here, gave it a shot, and it's been going pretty good ever since. Right now, the team looks like I think we have 8 in the office. We have about 30 to 35 active deals. We don't turn over that many monthly because we do some rehabs. So about 20% rehabs of our active deals. So actually, probably less than 20% of total turnover is flips. And then we do some rentals, but not a lot. Rentals in the residential space are difficult to scale. But we have a lot of seller finance notes that we originate. We buy a property, sell it on terms to an end buyer on a note. So those are really good, really profitable. We're actually in the process of building a debt fund around that to warehouse the notes and cash flow for both ourselves and investors. So that's pretty exciting. We're pretty excited about that. Actually, it's kind of funny. It's right here. I got the legal paperwork right here. I got to read for the PPM. It's like, oh crap. And it's been there for like a week. So I haven't got to it yet. And then the rest of our deals are wholesale. I'm sure there's some other random stuff we do that I'm not even thinking about, but that's most of it. Um, as far as the like structure of the business is concerned, like if I don't know anything about a deal and we made money on it, then everything's going great. So we tell the team, we treat the lead Like basically, we treat the lead the same if it's going to make $5,000 or $100,000 on a wholesale. Because if we have that process in place to generate the lead and to follow up with the lead and to negotiate and deal with it, then it's a successful outcome. Now, obviously, a 5K deal, if there's 25 errors and a bunch of stuff we can't track down, we'll put more effort into it at that point. But at least initially, like treat them both as if they're both the same level of seriousness, and that's like instilling that in the team has been a huge piece of our growth, I think.
Nice. So you started out in real estate and going all the way back to your first deal,
Yeah,
112 units.
yeah, it was
Right?
fun.
That's usually 111 units more than the typical real estate investor.
It was
So how was that, right? How you starting out with that deal of that magnitude for a lot of people can't even, they can't even, think about that at this point.
it was such a different market. So at the time, and I mean, some places that sub market are maybe returning to something similar, but it was such a different market. The deal price we bought it for like 6K a unit. So I think our all in was not our all in, but our purchase price was like 815,000. So sometimes something that's cheap maybe isn't worth what you're paying it for it. But at the time, we bought kind of everything that you're supposed to do. You bought the worst property in a neighborhood that's going the right direction, and went out there and did it. There are a lot of learning curves moving from commercial back to residential, or I guess not even back to, but really into residential. The biggest benefits and the biggest learning aspects of that were building the team around the thing. We fired a couple property management companies because they weren't very good, especially when it came to the rehab stuff. We actually had to sue one and ended up putting him out of business. That was exciting. So we went through a lot of stuff really quick at the age of 24, 25, 26. That it was, I mean, it was a lot of fun. It was genuinely a good experience to have gone through. The financial outcome was not great, but that's actually more the market than the properties specifically, I think. Because the rehab, we got stuff up to about 90 to 92% occupied before the crash. Just went in there and did fun things that crashes tend to do. So it was a lot of work. And the biggest learning curve going to residential from that was when you have economies of scale all in one spot and one spot that you're going to for a massive renovation project. You're doing the same thing over and over and over again. So it's a lot easier to get in a good groove of like turnover, turning over units, getting prep done. You have a staff, so if you have a vacancy, it's easy to just pull some guys literally from like next door to go like touch up paint and stuff and have a turn on that side. So that was a big like figuring that out in residential was took probably years, like that, just that simple thing. Taking the residential side from okay, each house is different. Now, what are we repeating here? We're not repeating the house necessarily. We're kind of repeating the same look, the same process, but what are we repeating? We're repeating the process for getting the deal and building the team around like the acquisition process for like developing the deal. And when I figured that out, it's like, oh, it's actually pretty much the same as commercial. It's just spread out all over the place.
Right. So that's really interesting that you brought up, the fact that you're able to learn from your first couple of deals and then applying it to really like a different subsection of real estate. But kind of the same mindset applies as well. So I do want to touch on something else before we get into, kind of deal acquisition and your process of that and how people can learn a little bit of that as well. Going through the crash, right? So there's not, I guess, like, well, there are a couple of investors that, probably are out there who's been through the crash, but you really started investing before it, and then you
Mhm.
went through it, suffered the kind of the consequences, and then you are now back on your feet doing better than ever. So let's talk about that for a second. What are some of the things that you learned going through that? If you were to go through it again, was there anything you would have done differently? How would you kind of approach it, or even prevent some of the losses that you would have taken had you gone back and did it again?
Yeah, so fundamentally what happened is in commercial, let's take 100 units at a 10 cap, which is unrealistic obviously in any marketplace. But fundamentally what happens in commercial is you buy, 100 units at a 10 cap, and if you raise rent by $100 without increasing your expenses, then you make $1 million. It's pretty straightforward math. It's kind of cool. And, take it down to a 5 cap, you only got to raise rent $50 to make $1 million, I guess. Um, so it kind of goes the other way. If you're in a overbuilt submarket where there's oversupply of inventory and there's less jobs in their work. So I mean that's fundamentally what happens in a situation like that. So people say, how do you recover or whatever? Fundamentally in a 2008 kind of situation, and I don't think we're bumping into that at all in this marketplace. We're bumping into different kind of structural issues. but everyone's in the same boat. So, I mean, misery loves company, I guess. When you walk into a bank that you're trying to short sell a 98 unit apartment property complex with, and the bank has one name on the door 1 week, and they have another name on the door 3 weeks later because they just got liquidated by the FDIC. It's like, well, it kind of sucks, but it really sucks for them too. So that's, I mean, it doesn't make it better, but it means that it's not as bad, at least if you look at it from that perspective. Now, I knew guys that were talking about all kinds of stuff. You hear stories anecdotally, people jumping out of windows because they lost their 401k when the stock market crashed and all this other shit. It bounces back. And as a matter of fact, I had a friend of mine. I guess it's don't sweat the small stuff and don't worry about the losses because they're always going to happen in any business model. A friend of mine's dad, I think he ended up basically giving himself a stroke because of the stress and ended up dying a couple years later. Just because he was older, he wasn't like, I don't know, maybe not the healthiest guy going in, but he's just stressing so much about it. Like, don't stress it. Shit happens, dude. It happens. I was playing golf with some guys, one of our private lenders, 2 days ago, and another dude that actually used to caddy on the PGA tour. So that's kind of cool. So we were talking about stuff, and they were telling me about another buddy of theirs that was worth like $50 million before the crash. And then the crash happened. He kept buying on the way down. I guess I don't know anything about it, but whatever. Kept buying on the way down, and ended up running out of money. Ended up losing it all. Ended up like going from a 7,000 square foot badass house to like renting a 3-2. And in 2008, nine, whatever, whenever all that happened, and now he's worth, he's not quite worth 50 million. He's only worth 20 million. So the skill set you learn by taking advantage, honestly, the skill set you learn by going through something like the crash, as long as it doesn't handicap you and cripple you, like mentally, because it's not about the money, but the skill set you learn by going through something like that in terms of understanding how to work in the marketplace that you're dealt, serves you so much better when the market swings back up again. So the best time to get started, regardless of the situation, is always right now, because you can't go back in time and you can't worry about what tomorrow has. You can make educated guesses and make educated investment decisions based on where you presume the market's likely to go, but you don't know. And sometimes you're wrong. So there are a lot of people wrong in 2008. So the best time to get started is always right now.
Right, absolutely. I think, if you want to be in any business long term, the market conditions, if you will, shouldn't play too much of a factor into whether or not you should start the business now or
No,
a little bit later, because you're going to be in it long term. And if you think of it from that perspective, you will have to anticipate that sometimes there are going to be downturns and sometimes you're going to have really great years as well. And just
absolutely.
it's a balance of that.
Yeah, and I think it's important to don't be reckless. Like if you have reason to believe interest rates are going to go up, like they started going up. What was that? Was that 2 years ago when they started going up? Yeah, a year and a half ago. If you have reason to believe interest rates are going to go up over a year and a half, 2 year time frame, which I mean the Fed's been projecting that forever, then you adjust your investment like strategy to fit what the marketplace is doing. But you have to understand what the direction the market's going in as well as you can and how to fit in there, because there's definitely fantastic deals to be had. You just got to figure out how to get them, and you got to figure out how to work through the deal process to manage your risk.
Right. Absolutely. So before we get into that a little bit, just one last question on essentially navigating maybe like a down market. I've heard a lot of investors and even realtors, maybe it's a different perspective there because there's not a lot of risk involved for a real estate agent. Uh, but for an investor, right? Would you suggest, what is your take on this, right? Being a little bit more aggressive or not as aggressive during a downturn? Because I know a lot of people, even now say, hey, man, if I was back in 2008, I would have been buying up everything
No, you
regardless
wouldn't.
and I would be a billionaire or something like
Yeah,
that.
what,
So
what were they doing? What were they doing when that went down?
nothing. I've seen memes of
Yeah,
younger people who are like, I shouldn't have been messing around in third grade. I should have been buying up properties. That's the one I see a lot of. So,
yeah. The thing that people don't understand with something like that, and why, um I'll answer the question, but the actual right answer to the question is pretty straightforward. It's we talk so much about this business being relationship based, and then it's difficult to implement that because we're in a transactional business where we get paid on the transaction. But that being said, in the good times, it's so important to build good relationships with good people in the industry and in the marketplace. And it took me probably a long time to really kind of figure that out. And that sounds airy fairy. So what does that actually mean, like practically speaking? It means, for me anyway, make sure we have a team that's competent, that's able to negotiate, that's able to be autonomous on a deal, with their part of the job. make sure they're taken care of well, make sure they are able to be sufficient financially based on what they're able to produce for you. But it also means that understand your lender relationship. So if you're dealing with hard money lenders, well, yeah, they all change their terms, they do different stuff, but they will work better with you if you're upfront with them and if you have a good relationship with them. Same thing with private lenders. The people that it's generally not. I don't. Sometimes it's people my age that say, "Oh, I wish I'd done such and such in 2008. I would have." It's like, well, I mean, you didn't, so clearly you wouldn't have. But what people don't understand is markets don't shift in a vacuum. So when a market changes, there's contributing factors that make that happen. And then there's after effects of why that happens. So I just mentioned a while ago, the bank that I went in negotiating with a short sale um, was going out of business. Well, what does that mean? That means that there's less liquidity in the marketplace. So everyone's like, oh, I would have bought all the properties. Like, with what money? You're broke. You're still broke. You were broke back then. And you haven't built any relationships with anyone that has any money. Oh, and if the stock market takes a 30% haircut and California real estate drops by somewhere between 30 and 60 to 70%, everyone else is broke too. So finding money actually becomes a lot more difficult. We saw that like really, really quickly during COVID for about 2 months when all the hard money lenders and all the non-QM lenders like kind of just stopped lending. So the simple like, oh, I'll just borrow money from anyone because there's deals all over the place and I'll just like buy a bunch of stuff. Yeah, that sounds awesome until you need to actually pick up the phone and say, "Hey, bro, you still got any money left?" No. All right, I got to call like 20 more people. So relationships are so important in a down market, so much more important in really any market, and taking care of it and nurturing those relationships. So something like that's never fun to go through. But we never did the bankruptcy thing. We never like didn't pay an employee or a subcontractor or anything like that. And the banks, they all got their bailouts. So, if they take a little loss on their balance sheet, it doesn't hurt them at all.
Right. Yeah. And I think what you guys were able to do, right, that goes back to the building relationships, right? You guys took care of your people. So that way, in a bad market, they stuck with you. They, maybe even put out a good word. So that way, when you are, I guess, back on top again, um, things work well, right? Because you took care of your people, you took care of your relationships, and you weren't just, I guess, tossing people out like they were the scum of the earth, if you will, just because you're having a bad year.
No, yeah, for sure, for sure. The mindset that keeps you out of, oh, we're at the top because stuff's going up. Well, when stuff's going up, you're always fundamentally at the top, right? In a marketplace. So, oh, I don't want to buy the top. Well, if the top isn't the top yet, then that level of caution is going to prohibit you from taking advantage of stuff when it's really, really bad. Also, because like, well, what if it gets worse? What if it's not the bottom yet? So, fundamentally, just go out there and do it, and realize that you're absolutely going to fail at some point. You're going to lose money on a deal. You're going to be in it, 16 years and once in a while lose money or break even on a deal. But if you're doing 35 deals at a time, it doesn't really hurt. For me anyway, what's peace of mind is kind of almost counterintuitive is having a bunch of deals on the board and having a big volume of deals is a lot more peace of mind than having one or two deals. Because if you have one or two deals and something goes wrong, it's going to mess up your whole quarter, maybe 6 months, maybe a year. I don't know. If you have 30 deals on the board, as long as your business structure is sound, as long as you're buying right, and as long as you understand the marketplace that you're playing in, then and if you're able to turn stuff over relatively quickly by not getting like bogged down in operational drag, then your business should be relatively sound. Now you're still gonna have hiccups. You're still gonna have increased costs and all kinds of stuff. But if you're playing that much in the marketplace, you can see some of that stuff coming if you're smart.
Right. And if you have a big enough pipeline, right, then you basically covering your bases, right? It's actually better to have more deals than to have maybe just one or two and just really banking on those because it reduces a lot of that desperation that you actually
Oh, for
have.
sure.
So,
Yeah. Don't do 20 crappy deals because that's not a sound business.
right,
But doing 20 deals and having one turn out crappy, that's not so bad.
right. So let's talk a little bit about your process, right? How are we able to get so many deals coming in, build that large pipeline so that way you're not only just getting out there and really covering all your bases, but also being able to, like you said, do a lot of great deals or a lot of deals that are making you money, right? So let's start there. What is your marketing process? How are you getting in front of properties and homeowners or deals that you guys are able to review and then acquire in your business?
Yeah, absolutely. The key fundamental comes back to the people. So the marketing and the process and all that stuff feeds the people that are in the organization. So the way we're able to there's kind of two different questions. How are you able to get a bunch of deals? You spend a bunch of money on marketing. How are you able to get a bunch of good deals? Well, marketing kind of is what it is. You're going to get what you're going to get. So the only way to get a good deal is to spend a lot of time on training with the team and make sure that they're empowered and enabled and have the knowledge base to buy better and build relationships with sellers better than the competition. And it sounds kind of like a jerk thing to say. Just be better than the other guy. Because if you're coming up at an appointment for an acquisitions appointment on the phone or in person or whatever, and you're more honest, if you're better able to explain the process, if you're better able to explain the outcome that the seller's going to get from working with you versus the competition, it doesn't mean you go pick on the competition necessarily, unless you know them. But the better you're able to explain all that stuff like on the front end, then the better you're able to serve the seller's needs or their like fundamental desires. Because for the most part, the sellers are always money motivated to a certain extent, but generally money is not the main thing that they're motivated. It's not generally their main motivating factor. Generally, their main motivation is something else. Sometimes you know it, sometimes you don't know it. Our job is to figure out what that is and then solve for that problem. And then that's how we get the house. So the outcome of that is very often, and people are blown away when we talk to our friends in the big wholesale outfits, blown away by how much less we sometimes offer on some properties and still lock them up and get them. And we'll know we're going up against someone else on a property. And I think our record right now is a 65K below the other guy's offer. And we got the property because we built the relationships on the front end. So the only way you do that is by training and by negotiation practices on the front end when you're talking to sellers and to transfer that to the team. Um, there's a I think small business owners and entrepreneurs and especially solopreneurs do themselves a disservice when they say, well, I can do X better than whoever it is that I'm going to hire to do X. That's kind of accurate. But what I found is if you hire someone that's good at doing X and that's their one job, because I might be good at doing X when I'm doing X 100% of the time. So negotiating acquisitions. Turns out I'm actually not, but let's assume that I am. Uh, okay, that's cool. But if I'm dropping off paint and if I'm at my kids' game or picking up kids from school or arguing with a contractor or dealing with a buyer on something else, if I'm trying to do everything, then I might be able to do my one thing like acquisitions really, really good when I'm doing it, but I'm only doing it 50% of the time, even when the phone call's coming in and ringing my phone. So then empowering the team is their job is to do that one thing really, really good. And if you hire people that are smarter than the average bear, then they still should be tasked with doing one or two things really, really well, but they'll understand how well that thing fits in the overall structure of the company and how they can then use the negotiation process to buy better and buy deeper by fulfilling the seller's like needs and overcoming their objections. So that's how you increase your margin. Now volume is you spend a bunch of money on marketing, you pick a marketing channel and figure it out because they all work. But they don't all work for everyone and they don't all work in every market.
Right. So that's a really, really good piece of advice that you just gave there as far as being able to communicate better with the seller, right? So the example you gave, you guys offered 65,000 less than the other I guess the other bidder there. So that's really impressive, right? As far as an investor goes, you don't see that a lot. You don't see that very often on the marketplace. So
We see
as
it
far,
about once. We see it about once a month.
once a month,
Yeah, more or
that's pretty
less.
good. That's pretty good. So yeah. So how are you able to do that, right? So you mentioned the negotiation process. Is there a framework that you guys use as far as being able to go out there and negotiate with these sellers? What is the core fundamental as far as being able to communicate the proposition better than all the other investors out there who are pretty much, if you think about it, doing the same thing. Maybe they're just communicating their message the wrong way.
Yeah, what we're qualifying the seller. We're not qualifying the property is the short answer to that question. So that comes we're heavy in the inbound marketing channels. So mail and PPC, Google PPC are both inbound lead sources, so they're coming to us. So there's already a certain amount of urgency on the part of the seller when they're contacting you for a solution to their problems. Now there's competition in that space. There's a lot of competition in that space. So now how are we better than the competition? Well, now the first step is follow up quickly. So when a lead comes in and hits either one of those sources, the phones if it's mail, or the email and text if it's like an online form, it goes out to the acquisitions team. It goes out to I think all of them actually, and some of the leads even go to me, so I can just like kind of be aware of like when leads are coming in. Now I'm not taking the leads and I'm not calling them, and then get back to them quickly. So open up the door and build a relationship quickly because you build trust slowly, but you start building trust by being prompt and being diligent about it. The next step is fundamentally kind of two parts, I think. One is where a bunch of the cold call guys get into like kind of margin troubles without being like without like not really buying as well as maybe they could is all the VAs. Like I get calls from VAs on our rentals, like, "Oh, you want to sell your house?" Like, "No, not really." "Well, for the right price, would you sell?" Like, "Yeah, I'm thinking about it." "Well, tell me something about the house." Like, "Well, it's a house." Like, so none of that stuff matters, right? There's no relationship building there. We don't care about the house because there's a price that will buy, as far as I know, probably any piece of real estate in the United States for the most part, unless there's something really toxic that I don't know about. For $1, I'll give it a shot. I don't care. So we don't care about that. We're not qualifying the property. We're not if we're talking about, "Oh, well, when's the last time you replaced the AC or the roof?" We're using that as filler to like so really quick run comps or to listen to some of the background noise in the conversation or something else. But there's a purpose behind those parts of the conversation. Um, and I mean, you don't want to sound like you don't care about the house because you do. So, tell me a little bit about the place. But as much as I want to tell you is all that you really need to know. Because in that conversation, they're going to say why they're trying to sell. And they're trying to sell not because the bathroom hasn't been updated since 1942. They're going to sell because their grandma died in the bathroom that hasn't been updated since 1942. And her shit's piled up to the ceiling in the back bedroom and they don't want to deal with it. But you don't know that by asking them, like, well, tell me, is it a hoarder house? Is it a probate house? Is it a pre foreclosure? Like, they're not going to tell you that. So you ask a bunch of really open-ended, honest questions with the intention of building rapport, and that only really works with a team that, in my opinion, is in-house and is relatively intelligent and sophisticated and able to have those conversations. So obviously, we have basic scripts and stuff that we kind of go off of for guidelines, but we're not trying to follow a script. We're not trying to check off boxes on an intake form. We're trying to figure out, okay, what's the seller's issue, and then step probably 4, I guess, is probably the next step. Is if it's metro and we're able to get to it, we're gonna try to set an appointment in person. Now, a lot of people are like, "Well, why don't you just go virtual?" And I mean, we do that, but we're better at it in person when we're negotiating one-on-one with the seller, because now we've built a trust and rapport and have a relationship with them, and we're not going to beat someone by 60K by being virtual. Well, we can probably beat them by 10 or 15K, but the only way to like actually buy really well is to build a relationship with the sellers that want to sell the deal.
Right. So it's a new way of looking at things, right? So that's what I heard. Instead of trying to qualify the property, you're qualifying the seller instead. Whereas most investors, maybe they look at the property first and then they look at the seller as far as building rapport second. You guys basically just change it around. You
Oh,
guys
for
put the
sure.
seller on the stage in the spotlight and say, "You're important to me. How can I help you? How can I solve your problem?" And then if it makes sense for us to buy, then we'll buy it. So that's a completely different shift in mindset and in
For
your
sure.
communication as well.
And we have a couple of sayings that we like using in the industry. One is, I don't really know them that well because I don't do them because it's not my job. But one is, we don't try to buy every house, but we try to help every seller. It builds a lot of trust. It's just a psychological thing, and it's true, because if there's a way to help a seller that fundamentally maybe doesn't really want to sell but thinks they have to, obviously our most desirable outcome is we want to pay them cash and buy a house, make a bunch of money on it without any trouble. But we got to do part of the training of the acquisitions team. I think I mentioned is making sure that they're treating the 5K lead the same as the $100,000 lead, because it's all about the process of doing it. Yeah, I mentioned that in the beginning. So same thing when we're talking to sellers. Like, we're trying to build that trust by doing that. And if selling to us isn't the best option, then or it isn't an option at all, then we don't pursue that. We'll pursue, a realtor thing, a loan mod, some other situation. Um, so that's a huge part of the business too. Is just that level of honesty with the sellers. What's another one that we'd like to say? Uh Shit, I don't remember. I probably listen to the acquisition team more.
Right. It'll come to you. But no, I like the approach because I think for a lot of investors, the problem they run into with acquisitions is they don't really know what they're doing, as far as what problem they're trying to solve, right? They just kind of approach it as like, oh, this is a property and I need to buy properties as an investor. But you got to treat them like you're serving a customer, right? And
Yeah.
the part where you're getting compensated on as you're buying it, and then you're able to cash out on it with your exit strategy. So it's a very complicated business as far as that. It's not just very direct as far as, hey, I got a paper pad here and I'm going to sell it to you for $5. It's you're solving somebody else's problem and then you're turning that
Yeah.
problem
I think
into cash for you.
I think a lot of people in the marketplace, you're absolutely right, 100%. I think a lot of people in the marketplace project their expectation of an, I mean, we see it all the time on Facebook. people project what they're guilty of on their rants on Facebook. So I think a lot of people in the marketplace project their desires for a specific outcome on the opposing party in a negotiation because it's low level and fundamentally it's not very sophisticated, but it's a good starting point if you don't really know any better. And what I mean by that is I want to make $100,000 on every deal. Now, obviously, we don't, and unless we pass up 90% of the deals we do, 95, I don't know what the number is, then we never will. But that means that if I'm not good, well, if I'm not good at negotiating, I'll never make that anyway. But if I'm newer in the industry, I'm going to project that expectation on the seller. So now what are we doing? Well, we're taking the seller out of their shoes and putting him in our shoes and saying, Mr. Seller, obviously you want to sell for the highest you can possibly sell for because that's going to get you the most money to give you the most ability to do whatever it is that you think you want to do. And I'm the best choice for that. So now all we're doing is competing on price. And I mean, I think every other industry understands, the car industry understands it. If I want to buy a Ford Focus, do they still make those? I don't know. I know I'm going to spend $2,500 because I don't even know if they still make them. I don't know. I have no idea. If I want to buy a freaking Aston Martin or a Bentley, like I'm not competing on price. I'm competing on, well, what do I get? So it's a little weird, but don't put our expectations of what our desired outcome is on the seller. Otherwise, we're going to be both on the same team, and neither one is the team of the seller's team. We want to be on the seller's team. And the way we do that is by understanding what the seller wants. The seller always wants money. Sometimes. I mean, not even. No, we bought a sub two. We paid $1,500 to the seller. And that's an anomaly. So I'll use like extreme examples to make extreme points. But the seller walked away with $1,500, and we got a house that cash flows $500 a month. Now we got to put a little bit of work into it for repairs, so we're out maybe 15 grand for a $500 cash flow on a house with a fixed 30-year rate for the next 28 years or whatever. So anyway, you can't do that if you're trying to buy the deal with the seller. You do it by following up and fulfilling the seller's needs.
Right. Absolutely. It's almost well, really it is irrelevant for the seller as far as what do you want out of the deal, right? It's what do they get out
Yeah,
of the
for sure,
deal,
for
not
sure.
what you want. Right. So kind of going along that path for a second. So as an investor going into these conversations with sellers, right? What would you say is the difference between, if somebody was a real estate agent who was going in there, because real estate agents talk to sellers every day as well, and they're trying to essentially do the same thing but not really, as far as getting something out of it, getting a sale out of it. So as far as the two different mindsets there, what would you say is the biggest difference there, and how does a realtor make that mindset and change over to an investor mindset?
Yeah, the biggest issue we see with realtors, and nothing wrong with realtors. Some realtors make really good investors, but a lot of kind of uh, traditional realtors don't make great investors when they come to negotiate with a seller from that perspective. Is the realtors don't understand what their objective is personally. They think they do, but they don't know how to get to it. A, and then B, they don't understand who the principal in the transaction is on their side. Because most realtors will go in with I want to be a realtor. I want to win the listing. Well, how do you win a listing? It's easy. You say you're better than the competition, and I'm better than the competition because I can get you more or I can sell it faster. I mean, that's pretty much the only ways you can be better than the competition as a realtor. I follow up really well and I answer my phone. I mean, and that's good. And there's a lot of realtors that make a lot of money doing that. But if you approach a seller that you're trying to buy a distressed property from a perspective of I can get you the most money, well, you're already probably wrong. And B, you're not representing yourself well. So some realtors think that there's a conflict, I suppose, representing yourself and purchasing a deal. No, there's absolutely not. If my wife is representing me purchasing a deal off the MLS, uh, her job is to negotiate well on my behalf to get the house for whatever it is. If I say overbid by 50K because that's what I really, really, really want to do, maybe her job is to make a recommendation that, I don't know if we have to overbid by that much, but if you say do it, let's do it. But if I'm a realtor and I'm buying a house from someone, I'm representing me as the buyer to the house. So then what's the fiduciary duty? Well, the fiduciary duty is to myself to pursue an outcome. So, oh, but what about the code of ethics? Well, the code of ethics is very important. What does that code of ethics say to the opposing party? Well, the code of ethics doesn't say that, hey, Mr. Seller, I have a retail buyer, I'm a realtor that I'm representing, and my retail buyer is willing to offer you $100,000 more than what my offer is going to say. Like, okay, that's the I'm not serving my principal in that transaction as the buyer. So why would I be any different if I'm representing myself? Like only I know what I can and will pay for something. I'm not disclosing that to a seller, but I'm being unethical. No, I'm not. what the Realtor Code of Ethics says is our duty to the opposing party is to be honest about the transaction, about the nature. Don't misrepresent material things. So if you're selling, don't misrepresent stuff that you know that needs to get done to the house. We don't do that even when we're wholesaling because that's not ethical. If we're buying, don't represent yourself as a cash buyer if you're not a cash buyer. Uh, if you're wholesaling a property, don't misrepresent the wholesale process to the seller. Now, you don't necessarily say, "Hey, Mr. Seller, I really need to wholesale your property. Mr. Seller, do you know what wholesaling is?" Well, you're not trying to make yourself sound smart. You just explain the process to the seller of here's how we're getting to your outcome. Do you like that process? And here's where people might have a problem with that process, and let's talk through it. That's being honest. Being honest isn't, hey, Mr. Seller, I know I can pay you an extra 50K for that property, but I don't feel like it. I mean, that's just stupid.
Right. Yeah. I think it's a lot of realtors just have that kind of mental block of like, am I even allowed to be an investor? I get this question all the time from other real estate agents. Like, can I even be an investor as a real estate agent? And the answer is absolutely yes, because just because you have hold a real estate license does not mean you can't go out there and represent yourself on these properties. And it is perfectly legal, even if you weren't a realtor, to go out there and buy real estate and invest in real estate on your own. So having that license shouldn't hinder you pursuing this aspect of the business of being an investor and acquiring properties on your own behalf.
No, definitely not. And the same as I kind of talked about the negotiation, the way we win the deals isn't by trying to pull the wool over their eyes as a seller. It's by being more honest, more transparent, more upfront. We have sellers that come back to us. We'll say, hey, if we're the first in line, like we try to be first in line, but whatever, if we're not, or if we are first in line, we'll say, hey, I know you told me you got 3 other people coming. Watch out for this and this and this. Watch out for no option period. Watch out for a long option period. Watch out for very little or no EMD, and watch out for and or signs on the contract. These are all 3 of these are red flags. Does that mean the other guy's a bad guy? I don't know because I don't know the other guy, but those are indicative of someone that might be trying to wholesale your property, which is fine. But if they don't tell you that that's what their intention is on the front end, then they already have a shady, like confrontational nature. And sometimes the seller's like, you know what? I just like your honesty. I'm going to sell for you for 30K less. Okay, cool. Well, for that price, we'll definitely do the cash buyer. Or they'll come back to us after the 20-day option period and be like, yeah, about that other guy, they wanted to offer me 15K more and you wanted to offer me 15K less, but they didn't close. So can I just sell it to you for your original price? Well, yeah, that's fine. So they'll come back to us. So we win the contracts by being more honest, more upfront with the sellers about any aspect of the process. If our intention isn't to close on the property, then we explain what our intention is and how that achieves their objective. Because we're selling the objective, we're not selling the process. The process is just how to get to the objective.
Right. So a question that comes up for me is when you are explaining this process to the seller, right? How do you do it in a way where, you're not getting into too much of the weeds as far as the details go, where, it
Yeah.
starts to confuse them and they're like, what's going on? And it gets to a question answering process that can last up to like 3 hours.
Well, if you want to make 100 grand, sometimes you got to talk for 3 hours. Uh,
Right.
so, um, stop with the jargon. Like, I mean, that's the biggest thing, right? Just stop with the weird, fancy jargon. Novations. I don't know if you know anything about novations, and that was me starting with jargon, right? But that's a great one on the marketplace. It's all big in the guru space right now. Is like, oh, just novate everything and do novations and explain to the sellers the novation process and all this other stuff. And novations have a very interesting and unique and I think beneficial place in the marketplace where they're useful. But if I'm going to come up and explain some fancy legal term about signing second contracts and limited power of attorneys and a bunch of random stuff. And if I'm explaining that with the legal stuff, then like you're getting glassy eyed. They're not gonna pay attention. The seller's not gonna pay attention. And Mr. Seller, do you know what a wholesale is? Oh, well, let me explain how smart I am because I know what a wholesale is and I can explain to you what a wholesale is really, really good. Seller doesn't give a shit. Like, hey, Mr. Seller, yeah, we might have to wholesale this property based on like just the margin, like our cash price is here, but here's how we can probably help you move this property. And here's the process that we're going to employ for moving this property. And hey, if you're down for that, let's give it a shot. Same thing with like a novation. Mr. Seller, have you ever heard of a novation? Of course they haven't. They're not in real estate. Oh, well, let me explain to you how smart I am because I can explain every detail of a novation. No, who gives a shit? That's the point of the paperwork. The paperwork explains it. You explain, here's the process for doing this. Here's the likely outcome for you for the end result. And if there's a breakdown in communication, if there's a breakdown in that process at some point, then we'll be there to walk you through it. And we'll be there to say, hey, here's what we think is going to get this transaction closed the most efficient way. Oh, okay, that sounds reasonable. Let's do that. So it's never about misleading or lying to the seller. It's about providing them enough information about what the expectations are, and then managing the expectations along the process. Same thing with an airship, right? If someone dies and there's 12 heirs, walk through the process. Oh, I want to close it in 2 days. Like, well, that's not physically possible. So the next guy that comes in and says, I can close in 2 days, they're lying to you. So here's what needs to happen in order to close as quickly as we absolutely possibly can. And we promise we'll work with you as hard as we can to get that done in that, in as short a time frame as possible.
Right. You want to explain it in a way that makes sense to the seller, right? You want to explain it so that they can understand. You're not trying to explain it so that you know you can sound smart. So
Right.
you got to, again, always put yourself in the shoes of the seller, right? What if you were in that position, if you didn't know anything about real estate, if this was your first time learning about all these things, what can you say to yourself that will be easily digestible, right? That would make sense, that would allow them to actually trust you and make a decision moving forward, that can open their eyes up to the possibilities, if you will.
Absolutely. Absolutely. Yeah. I mean, yeah, there's a reason Donald Trump got elected. It's not because of Russian interference. It's because he speaks at a sixth grade level, and he speaks in a way that everyone can understand. I like him or hate him. That's absolutely why it happened. Because we need to do the same thing. Like, I'm not interested in proving how much smarter I am than the seller. Like, that's not part of the process at all. All I'm interested in doing is having a sixth grade level base conversation with someone to explain things as simple and as straightforward as possible, and give them the most clear cut, straight path to their desired objective.
Right. Absolutely. Know the audience, right? Know who the audience is and communicate on their level, not
For
yours.
sure.
So,
Yeah. Now, if I'm talking in front of 200 investors and we're talking about novations, no, that's different. Now I'm there for my entertainment. Like, now I'm there to prove how smart I am to 200 investors or whatever. But that's a different audience. It's a different purpose.
right. Absolutely. Well, TJ, I want to thank you for being on the show today. You shared a lot of value with us. I personally learned a lot from you as well. And I think anybody who's listening or watching this can take away a lot that they can apply in their current business right now. So, for anybody who is watching or listening to this that want to learn more about what you do, that want to follow you, or just kind of be a part of your journey, if you will, what are some of the best places, either social media, website, any email list that they can follow you on?
No, absolutely. I appreciate the opportunity. No, we're in North Texas. We have a pretty good presence up here. We do a bunch of parties and networking events and stuff like that. So we're super easy to find if we're local. We have a mastermind too, where we try to help people build the business they want to build, because there's a lot of fake kind of news in the marketplace about, oh, I think I want to do, X number of deals. Well, like, why? Why don't you just do better deals with the way you're doing them? So we try to focus on building a business based on their desires and their existing core competencies before we try to expand it. So it's a good service that we have. But other than that, I'm super easy to find all over Facebook, TJ Cozen, Instagram, TJ Cozen. I've bought deals from people sending me deals on Instagram, which is kind of cool. TJCozen.com, pretty creative. I don't know where we came up with that name. We actually have a pretty decent little YouTube page that we're fixing to relaunch. We have like like 70,000 subscribers, so that's kind of cool. And we kind of let it go dormant for a little while. You can find that on the Sicilian Brothers, because my business partners, but I think we're going to keep the name. We kind of like the name on YouTube. And then if anyone's interested in any of the education stuff that we do, we have reiAF, which is real estate investing, and AF, I don't know what that stands for, but it sounded cool. So reiaf.com is our kind of education platform.
Awesome. We'll make sure to leave that in the description in the show notes down below so that you can find it. And AF, that means actual factual, right?
Yeah, that's exactly what it is. Yeah, that's what it was. I like that one.
Right. Well, awesome, TJ. Thanks again for being on the show today. Before I let you go here, any last pieces of advice, any last tips you can leave with us before I will let you sign off?
Yeah, just the stuff we reiterated. Invest in people if you want to be successful, and if it's your first deal or whatever deal, you're gonna have failures and you're gonna have setbacks. Like, that's inevitable. So you need to go for it, because that's the only way you get there.
Awesome. Thanks again, TJ, and thank you for tuning in, and we will see you guys on the next show. Take care.